Okay, okay, okay.
Okay, good morning, everybody, and welcome to the Gulf Intelligence Daily Energy Markets podcast, where every morning in the UAE, at least early morning, where many of my guests are this morning, and we do appreciate that. But here in the UAE, it's 10:30 UAE time, and we sort of take the opportunity to have a quick snapshot of where particularly oil markets are moving in early Asian trade. And this morning, nothing really much changing. Brent and WTI sitting more or less where they closed yesterday, but solidly in the 80s, both of them. Brent moving towards 90 at 87.94 this morning, and WTI at 81.52. But breaking through that 81.50 handle, maybe things keep moving from here. Let's kick off this morning with Neil Atkinson, former head of oil markets division at the IEA, but nonetheless, I'm going to get him to defend his former colleagues who have come out with their latest report expressing their concerns that supply will not meet demand this year. I know that they slightly were caught offside last year, Neil, crying very, very big wolf on all things Russia. 3 million barrels of disruption never happened. They missed a lot of the calls last year. Why should we believe them this time?
Well, because I'm no longer there. That's why there was a perfectly obvious answer to
And
your
you weren't
question.
there last year either, but nonetheless.
No, that's true. No, the serious response is I think it is fair to point out that the IEA, I think, did jump the gun as far as the Russian supply fall-off is concerned. I said that privately at the time. But, in fairness, they were not alone in predicting a huge immediate impact. And, a lot of people were saying when the price cap proposal came in on crude oil in December, that would also be the end of the world. And now we're talking about the product price pricing regime to come in next month. So I think we need, the IEA are not alone in having jumped the gun a bit. Now, as far as the latest report is concerned, the IEA make it very clear that the uncertainties and the volatility this year are absolutely enormous. But they've made a big call as far as demand growth is concerned, posited on a big Chinese recovery. And that's a perfectly reasonable position to take. The other side of the coin is, of course, they are also looking at big increases in production from the United States, Brazil, Canada, Norway, Guyana, and I may have missed Looney Stanout or somebody else. I'm not entirely sure. So, they've gone with some big numbers on both the demand and the supply side, but they are suggesting that, we could be in for a tight market later in the year.
Rafiq Latta, senior correspondent at Energy Intelligence, sitting in Cyprus. Rafiq, how will OPEC Plus, do you think, be starting out the new year, and maybe more OPEC than OPEC Plus? Obviously, Russia really the only player in OPEC Plus, but OPEC itself looking at China reopening and some of these clearly tightening signals that the IEA are mentioning.
Yeah, so Happy New Year. OPEC's quite bullish on China, but not as bullish as the IEA. I believe the IEA has got something north of 800,000 barrels a day of Chinese demand growth pegged for this year. I think OPEC's just north of 500,000. So they're quite bullish. They have, by and large, weren't hit last year by the drop in Chinese buying. That drop in Chinese buying last year mainly came on the ARB grades. So I don't see there's going to be a big change there. What we probably are going to see is a bit more competition, and are seeing is a bit more competition from the Russians. Those prices are relative to Brent. The discounts have widened of late. I personally kind of feel we're not going to get a massive slide in Russian oil supply.
Products won't be disrupted by the fifth embargo?
Momentarily, quite probably. Long term, I just don't really see it. And the world doesn't need it. And the point of the price cap it isn't really to stop the stuff flowing; it's to enable it flowing after the embargo. And we don't know how this price cap, the product's price cap, is going to work. If it indeed it happens. So there is massive disruption. Of course, it hits the physical market big time. I suspect prices would be slightly higher, flat prices, if it wasn't for the discounts that the Russians are putting in. Well, I'm pretty sure of it. Nevertheless, I don't think we're going to see the big OPEC guys getting hit volume-wise that much up to the east. There's that much oil. What I did note, we'll have to see if it continues, is, basically what we've seen the last 2 years is WAF sinking. But
what's sinking?
WAF, West African grades,
Okay.
supply has been, in free fall.
Yeah. Although Nigeria has come back in recent months.
Yes, that was going to be my point. They're starting to come back. So that's something to watch for this year. And that will make a difference because basically they've so under supplied vis-a-vis their quota, and as a result, largely of the West African fall. So that's something to keep an eye on. I think OPEC will want at least noise about oil policy as supply policy as possible.
It drags them clearly into the geopolitical vortex that is all things Ukraine. Let's welcome Rob Barnett to the table, EMEA team lead for energy and commodity research at Bloomberg Intelligence. Rob, there's so many different questions that I could ask you to come in and give us your thoughts on, but let's just start with the gap between the supply and demand projected by the IEA. Obviously, that's an oil call on their part, but I wanted to get your insights on where is the energy transition and renewables? What role can they play in accelerated? Last year, your reporting indicated somewhere near 50% growth in global solar supply capacity. I'm wondering, where do you see that going this year? And is it going to be an increasing factor in closing that gap on energy supply and demand on the hydro side?
Yeah, so I think in the liquids market, wind and solar really don't compete with oil, other than to the extent that you think electric vehicles are at such high enough penetration that maybe you're charging those vehicles with a wind or solar electron. But there is some pretty relative and important read across for the gas markets, particularly in Europe these days. Right at the start of the crisis last year, we projected that Europe could fully get off Russian gas in 4 years by just going full throttle on renewables. Now, as you know, they did it in about 12 months, but they had a lot of other factors. We've had mild weather. We've had a big cratering of industrial gas demand. We've had gas to coal switching, and of course, we've had US LNG. But I wouldn't discount the role that renewables did play. And as you noted, they're the fastest growing segment of the energy space by far. Solar demand globally increased about 50% last year. These are unfathomable numbers if you're thinking about the kind of 1% growth rates you're accustomed to seeing in the oil market. So, and we continue to see a very robust outlook for renewables, not just in Europe, but globally.
Just to follow up on that, Rob, there was a lot of questions that I think remain whether Europe is abandoned the energy transition last year for energy security, returning to coal in a big way, even sustaining on some nuclear power plants in Germany. Where are they at this point in time in that sort of compromise energy transition for energy security and the commitment to renewables moving forward?
Yeah, I think it's very hard to have an energy transition if you have ignored energy security goals, right? So very prudent in the case of Germany to bring some of their coal plants back online. You certainly don't want people are falling short of energy needs during the winter time. So I think these decisions and trade-offs that were made were quite practical. They were, frankly, the reality of the situation. Either you have a shortfall in the marketplace, given what the situation that that Europe has found itself in with Russia, or you simply walk away from these goals. My interpretation, though, is that all governments and most stakeholders are full steam ahead on everything energy transition related. And of course, we know wind and solar are intermittent resources. They're not going to be the full solution. There's a lot of discussion about all kinds of new things these days, including hydrogen. You mentioned nuclear. I think nuclear is getting a very serious look in a lot of countries these days because of the role that it could play. Already, it is the largest carbon-free source of electricity globally, and it could keep that perch, particularly if governments are willing to invest in it. The only thing about nuclear that is sort of obvious and worth pointing out, though, is it tends to be one of the more expensive technologies.
Neil, looking at obviously the big driver, we started the year January with a somewhat very soft-looking oil price that has come back quite strongly in the subsequent weeks, mainly on the outlook for China and China returning to sort of a post-COVID world, but that the forecast by the A and others would point that in the second half of the year rather than the first half. Your thoughts on the China return story? Has it got too much wind in the sails at the moment, or is it the outlook you think tangible to predict at this point?
Well, there is the possibility we're all getting a little bit overexcited, but that there's nothing new about that in oil market analysis. Now, what's interesting here is it's the Chinese New Year holiday, I think, as we speak.
Yep.
And tens of millions, if not hundreds of millions, don't quite know the numbers, they're big numbers.
Hundreds.
Anyway. Yeah, okay. Chinese people have gone all over the country to visit their friends and family, and travel has gone through the roof. Now, when they all come back in the next few days to the big cities, what do you think might happen if there is a sudden big outbreak of COVID cases which overwhelms hospitals and the medical services? You would think that in those circumstances, it would perhaps be impossible for the authorities to avoid some sort of lockdown, even if it's only very short and even if it's only highly localized. Now, I don't know if that'll happen or not. But intuitively, if you still got COVID pretty rampant around China, which is in fact the case, and now you've got people traveling all over the place and coming back to big cities, that there must be the possibility of something of a stop-start situation in the earlier part of this year. I don't know, but it must surely be a possibility. But as we move through the year, you have to assume that the worst of the COVID outbreak in China is behind us and normal activity will gradually resume. And importantly, international travel into and out of China will start to pick up as well, because of course it's aviation which has been the laggard in terms of the return of normal demand patterns following the end of the pandemic. So that holds the key to some of the optimistic demand growth numbers which the IEA and others are putting out there. So yeah, China is very important, but there's a very important week going on right now. And let's see if there is any adverse impact as people return home from the end of the holidays.
We're already getting stories on the local radio here in Dubai after the surge of Russian buying property last year. We now have the start of a surge of Chinese buying this year as they come out from their hiding. Rafiq, where's Energy Intelligence outlook for China recovery? Is it more sober than the IEA? What's your thoughts on where the China opening story goes from an oil demand point of view, which remained quite solid through most of last year, above 10 million barrels a day of imports on average?
Yeah, so China demand, I don't have that number on me actually, but our physical trading reporters, they're kind of getting quite, they're seeing a lot of nerves about the Chinese recovery. I mean, like one guy was saying he'd be, he was working his company. On the Friday, they had 10% infection rates. On the Monday, they had a 40% infection rate. So it's going up. There are some jitters. But
the markets seem to be looking through that, don't they? I mean, at the end of the day,
I was just about to say, one of the big traders I was speaking to was like, basically Xi Jinping does not care. He has taken a strategic decision to open up. He will not go back, and he's going to push it through. And they're seeing buying. They're seeing a lot of appetite. A lot of these ARB grades that fell off last year from Brazil, from WAF, they're sucking them up, as well as a lot of Arabian Gulf grades. So there's a lot of physical discussion and stuff happening for February, March trade at the moment. And I suspect it'll take quite a lot for that momentum to slow. And that's part of the reason we've seen this jump in price, the main reason. It's underpinned by this real physical shift from China, from Asia.
Rob, is China reopening the biggest weighting on the direction of energy markets as a whole, but oil markets through the year ahead, or is the war in Ukraine still a possible bigger factor?
Yeah, I think we're certainly watching China as well. And, when we do our global supply demand balance for oil, we see oversupply here in 1H flipping to undersupply. And the big differential is China reopening, kind of getting through some of that turbulence caused by COVID cases that might be happening here in 1H. And it's absolutely a key driver for us as well. But obviously, there's numerous other factors we're watching. The other things I would point to that will be a very big catalyst for the oil market this year would just be the recession question. Are we actually in a global recession? How deep is it? And will we exit it quickly? If so,
there's a very strong growing narrative in that favor, right? That we went into Q4 into Christmas holidays thinking it was the end of the world. We came out of it thinking it was the start of a new dawn. I don't know what changed, but ultimately it seemed recession disappeared.
Yeah, and a lot of the macroeconomic numbers, particularly in the US, look reasonably good, right? And so I think
it's hard to argue against near full employment.
Yeah,
even in the UK.
Yeah, the folks predicting lots of doom and gloom, fortunately, haven't been right yet. So I think there could be some signs for optimism there on the macroeconomic side, but let's wait and see. And then, of course, value of the dollar is critical, and obviously there's U.S. Policy decisions that kind of feed into maybe what's going on there. And I think you're right to point out there is still some geopolitical risk premium. How much of the current price you want to ascribe to that? We don't put a precise figure on it, but I think it'd be wise to continue to keep an eye on all of the questions around Russia in particular that you've already brought up on the call so far.
I wanted to also get your view, Rob, on the just the general macro picture in Europe vis-a-vis obviously the waking up on February 25th last year and realizing, oh my God, how dependent we are on Russian gas, which seemed to be, quite obvious. But now I wanted to get your view. How dependent in this push towards renewables? I mean, I read a somewhat alarming statistic recently that Europe, 98% of its rare earth imports coming from China. How vulnerable is it equally as it was on gas to Russia? Is it from the renewable energy transition to China?
Yeah, certainly. Look, at the end of the day, once you've got the equipment installed, you're maybe a little less concerned about where it was made in the case of renewables. But you're right to point out that a very big portion of the solar supply chain globally is in China, something like 80%. And we saw the US take some pretty significant action this past year to help try to manage that risk. They passed a bill that's somehow they came up with the name, the Inflation Reduction Act, but it's basically a clean energy bill. And a big part of that is not just that the US wants to do wind, solar, hydrogen, carbon capture and storage, and all these things, but they want to do the manufacturing domestically. I think Europe is probably going to take a very serious look at that question, because if they don't change the incentive structure, then you do sort of run the risk that the manufacturing happens in China or perhaps the US. I would note that the wind supply chain isn't nearly as concentrated in China. You do have Vestas, Siemens Gamesa, and Nordex all quite actively making wind turbines in Europe.
Neil, I'd welcome your view on the same question. We have today Janet Yellen in Zambia, and one has to take note each time a senior member of the US government takes trips to sub-Saharan Africa, because the truth is it hasn't happened that often over the last decade. But we had Amos Hochstein in the Congo recently talking all about cobalt. Now we've got Yellen in Zambia today talking about debt relief that is tied into China. Your thoughts on that, how big energy security and commodity securities in general will play in directing the sort of strategy in this year?
Oh, it's going to be an enormous consideration. There's no doubt about it. Here in Europe, we've had a huge wake-up call, of course, because of the Russian invasion of Ukraine. And having said that, it's been actually quite extraordinary how, when faced with a major security crisis, obviously Russian supplies of oil and gas, Europe and indeed the G7 and NATO working together have been able to achieve a great deal by actually getting their act together and finding alternative sources of supply. So treating it as a crisis issue has led to some major changes. As far as the longer term outlook for the rare earth that we were talking about a moment ago, people are waking up to the fact that there is this concentration in China. They're also waking up to the fact that for at least a decade, and probably 20, in fact, going back 20 years now, China has made major investments in sub-Saharan Africa and indeed elsewhere to secure supplies of raw materials. And they've done it by offering aid in kind, by building roads and hospitals and schools and all the rest of it. So the Chinese have been cozying up to countries in Africa and elsewhere for a very long time now. And it is quite interesting, as you said, Sean, a second ago, to see senior US officials going to places like the Congo and Zambia. They're not there for the tourism, there's no doubt about that. They're there because long term, there is this existential threat, possibly, of the concentration in Chinese hands of raw materials which are vital to secure the energy transition, which is the long-term policy of the US and other governments.
Rafiq, we had the energy minister of Qatar here in the UAE last weekend, and it raised a few eyebrows when he made the statement that Europe would be returning quite quickly to Russian supply once this crisis was over, with Ukraine ministers in the audience not too pleased to hear that. But I wanted to get your thoughts on that geopolitical piece. We see today Erdogan announcing that he was going to be not facilitating Sweden's access to the NATO, which, you know, we'll see where that goes, but I welcome your insights on that. In the same breath, at the time, Turkey and Russia are cozying up to the idea of a gas corridor through Turkey circumnavigating Europe. Your thoughts on some of those pieces looking forward in this year, geopolitics still front and center?
Yeah, well, Sadel Kabi is a hydrocarbon realpolitik guy, and you know he's got a point. I mean, Europe's prosperity, post-war prosperity, was built on cheap Russian gas, and you know there's no doubt that level of dependency will never return. That is quite clear. But it would make sense for a certain amount of it to return for Europe. You know, not just for reasons of or purely economic reasons. I mean, you don't want a Russia, an economic basket case, do you? I don't think that helps security, global security, with it being a nuclear power. So it would make sense. I don't know about short term, but in the medium to long term, certainly post Putin, for Europe to take quite a decent amount of Russian gas. Just before I go on to the other points, I just want to say there is this European Critical Raw Materials Act brewing as well, and I noticed just recently, the Saudis have launched a 15 billion mining fund for investment abroad. So this supply chain issue is like one of the big energy themes coming up, I think, in the next
very big part of the transition in Saudi Arabia is minerals. I mean, it's a huge country, the size of a continent, with lots of opportunities.
So the interesting thing, this is an international investment, abroad. So this capturing this, getting a slice of it, of this chain is critical. And I would say that it's kind of, the way I see it, it's the US and Europe's policy of putting sanctions on everything over the last few years that have kind of triggered it. I mean, we've seen them do that. And of course, you do that, you think, what are the Chinese going to do? Oh, they might do that back to us.
Well, there's now increasing talk in Europe about really grabbing that Russian money that was frozen in the early days of the war. Before I get your thoughts on Erdogan, Rafika, let me just bring in the survey question. I just want to get the room's view and get you guys to give us your closing thoughts on this. What will have the biggest impact on the direction of oil markets through 2023? Geopolitics, Ukraine, China reopening, US oil production recovering. We didn't talk at all about. It's not an immediate, but it is feeling like, a million barrels from the shale patch. I mean, there's still US down 1 million from pre-COVID levels, and the energy transition could surge forward again. So let's take the view of the room on that. But quickly, Rafiq, on Erdogan, do you see him blocking this expansion of NATO?
Yeah, 100% for the moment. He's got elections coming up, and it plays very well. And this guy Rasmussen, the Danish guy who burnt the Quran in front of the Turkish embassy, he's got a lot of previous. It just plays with electorate very well. I mean, I understand the Swedish argument is, these are the laws in our country, but I can also see how when Muslims go, I don't see this happening with a Torah, or an Israeli flag.
It does. I mean, Erdogan's always bargaining, always negotiating. So you never know what's the latest. I mean, look at the cards behind.
He will, if he buckles, he won't buckle. If he trades on it, it will be for a decent price. He's played this conflict very well, the Ukraine very well, and like typically, through his form, it's all high stakes. He ups the ante. He tries to extract the maximum benefit, and occasionally it does blow up in his face. He's not the most popular person with his former Western allies.
Rob, your closing thoughts again on the survey question, how you voted, and also where do you see the impact of the upcoming oil products embargo on Russia for Europe? There's an overwhelming result in this room.
So I'll tell you how I voted on the question. So I went for energy transition. I guess it's a bit of my own personal franchise, but in much of the energy transition topics we hit on earlier during the call related to kind of wind, solar, but some really interesting statistics from 2022. About half the buses sold globally were plug-in. About 40% of two-wheelers, so motorcycles, bikes, whatever, electric. 13% of passenger automobiles, electric last year. If you only have to go back a handful of years, and all of these would have been very close to zero. I think we are in the midst of a very rapid transition there. Is it going to suddenly change the fundamentals of supply and demand in the oil market overnight? No, It is not. We're going to need oil for a very long time. But I think we are going to start to see one of the key pillars of oil demand start to get chipped away. That's the transportation component. So keep an eye on that space, and I think it's going to be increasingly relevant. I agree with one of the other speakers who was talking about the impact of Russian sanctions. Look, we're really seeing that most of the supply, whether you're looking at crude or products, are finding their way onto the market one way or another globally. And our expectation is that that the markets will continue to find ways to get that crude and or product out there.
Neil, you get the last word. I mean, I didn't even include recession, peak rates, peak inflation in the options there as directing the travel as they did last year. Maybe that's short-sighted on my part. Your thoughts, Neil?
Well, I suspect that the rate of inflation that we've been seeing in this last year or so is close to peaking, I think, in most countries, partly because we're not expecting significant further spikes in energy prices in the next few months. So it could well be that inflation still at high levels, even when it peaks, it still means inflation is rising, and the central banks have a very, very tough balancing act. You look at the business news on TV every day. Some people saying that further rate rises are inevitable in the first half of this year, and then other people saying that they need to temper the pace of those rate increases and indeed start looking to unwind them as we move into the second half of the year. So the central banks have got a tough act, and it's a tough balancing act. And at the moment, it's still too difficult to call. PMI numbers in Europe, I was looking at that last week at an event I was at in Sweden. The PMI numbers are not too cheerful. They're looking pretty weak, down towards the 50 level. So, at the moment, it's still early to call. And there's these conflicting messages. Further rate increases inevitable, but we should also start to look to unwind them as the year goes by. So, we're in January. It's January the 24th, whatever it is. And I think we've got a very, very volatile year ahead.
Well, in the meantime, Brent crude oil does seem to be creeping up every day, although today a little bit soft on the open or the early trade in Asia. But Brent on $88 on the nose now, and the momentum in it does seem to be heading in one direction, with all things China giving it, it seems, the ultimate oxygen. And it would take some big sort of macro headlines, I think, to reverse that from the point of view of the economic outlook, or perhaps some fairly poor earnings seasons still to come in. Q4 earnings could be a dampener on the fiscal markets and take with it Brent. So factors there to consider in the short term, but we have to wrap it up there. Really great to have you guys. Rob Barnett, really wonderful to have you join us. Hopefully you'll be back. Neil Atkinson, thank you again as always. Rafiq Latta in Cyprus, great to have your insights as well. Certainly will be interesting to see where Erdogan goes with this whole NATO expansion as well as all other factors. But have a great day, everybody. 10:30 UAE time. We'll be here sort of banging on the numbers a bit. All the best. Thank you.
Thank you. Have a good day.
Take care.
Cheers. All the best. Thank you.